we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
The Indian economy continued to slow in the fourth quarter, with growth slipping to 5.8%. That's at the lower end of expectations. A brief mention of the numbers before we go on to get analysis on the state of the Indian economy. At 5.8%, fourth quarter GDP numbers are at a 20-quarter low. The expectations range from 5.7 to 7%. So this is clearly at the lower end of those expectations. GVA growth for the quarter came in at 5.7%. A brief mention of where the slowdown seems to be emerging from, and we go to both the sectoral data and also the data on the expenditure side. And if you look at the expenditure side data, this is of course the full year numbers at 6.8% growth for the full year. The hit in this quarter seems to have actually come in from gross fixed capital formation, which is an investment indicator which slipped quite sharply in the fourth quarter. Private consumption continued to weaken from 8.4% growth in Q3 to 7.2. Look at the sectoral side numbers and you'll see weakness on two key parts of the economy, and that is agriculture, where growth slipped to minus 0.1%, and manufacturing, where growth slipped to 3.1%. Let's go across to Pravin Srivastava. He's the chief statistician of the country. We're hoping to get some insights from him, not just on GDP, but also labor force survey data that came out today. Thank you so much, sir, indeed, for joining us. My first question to you is on GDP. What is your own analysis of the trends in the Indian economy, having looked at past data, revisions to past data, and then the data that came out today, sir?
Well, the data that we capture is basically on what the different sectors of the economy are, performing, and that's projected in the GDP estimates. And you've already pointed out where the downfall is in the agriculture, the manufacturing, and construction and transportation. So all of those are going down, and that's what's reflected in the GDP.
Can you give us any insights, sir, into the cause behind that? So, for instance, in agriculture, it looks like there is a problem both on real output, if you look at the real GDP growth numbers and the component of agriculture, but also nominal has been far slower. So clearly, that is one pressure point which would then be impacting consumption, demand, etc. in the economy.
Well, actually, we are data guys, so we capture what's actually being performed. And as far as insights are concerned, they are very evident in the sectors that are being revealed in the reports that we've released.
Okay. So what is the data suggesting on the sectoral side? Again, there's been a fair amount of volatility. Is there any reason to believe that this volatility could be statistically driven, for instance, in manufacturing, where there's been a sharp fall this quarter?
Well, there has been a fall because, their production data that we capture from the index of industrial production, that has also shown a downfall, and that gets reflected into the quarterly estimates.
Okay. Let me switch focus, Mr. Srivastava,
so there has been a downfall in the IEP, and that is...
No, sorry. Please complete, sir.
Yeah, I'm okay. I've completed.
Okay. Allow me to shift focus then to the labor force survey, which got released today. Now, it's very difficult to get comparatives, and I think, as you had explained, the comparative best taken is from 2011-12. But it does look like there is a sharp jump in all India unemployment firstly to 6.1% from 2.7%. Is that the right way to read the data, sir?
I have explained in the press conference that these are two different metrics, so let's not compare it. Take this as a ground zero for the new series of estimate that will be made available, and it should be used from that purpose. There are certain reasons why they're not comparable, and that has been explained in our press note, and it's also this change in the sampling design, the rotational panel. So many issues are there that make them non-comparable.
Understood, sir. But even if you take them as a spot, survey and a number there, so you look at categories like educated rural males, 10.5% unemployment rate, educated rural females, 17.3% unemployment rate, educated urban males, 9.2, educated rural males, 9.8. So the question simply is that there is, perhaps reason to go along with the narrative that unemployment in India is relatively high, and that something needs to be done from a job creation perspective quite urgently.
Job creation is a different ball game. What we have measured is through the periodic labor force survey, given a focus on education, and these are the figures that get revealed. So you won't have comparative figures from the earlier surveys. You will have only broad trends that can be compared, again with limitations in terms of the difference in the sampling design.
So
if you take these as absolute number, then just wait for the new results to come, and then you can get an idea about what the changes are. But the fact that we have given more focus to education is revealed in the figures.
Okay, so when do we start to get a slightly more comparable series of data on the employment, unemployment side, sir? You suggested June will be the quarterly release.
Yeah, the June will be the quarterly release, and then the survey for 2018-19 will also be over by the end of June. It'll take about a few months after that to process the annual results, because we have the quarterly and the quarterly in the urban areas and rural in the for rural we have annual figures, and when these two get compiled, so we'll take a few months after June before we get the 2018-19 data, and then you can start comparing.
So a couple of last questions. Obviously, there have been a bunch of questions raised about the comparability even of the GDP data, and I'll go back to that issue. As things stand now, we will probably see another change when the base year change comes into place. So again, there will be an issue of comparability.
Base change for the GDP series?
Yes, sir.
Are you talking about the GDP series or? Yeah. So see, what we are doing for the base change, there's a lot of studies and surveys that have to take place, and we're expecting the consumer expenditure survey results to be out by end of June, so that that can be used as a basis for looking at the distribution of consumption and used as a base for revising the thing. And the 2017-18 PLFS data will also be used for the base revision in GDP in terms of the workforce. So a lot of the information that is being, all the survey that we are planning aims to assist in the base revision exercise. But now, since we started using more technology, we're expecting that the results will be out quicker, and the base revision will be faster, so that the results, when they come out, you won't have a lag of 2 to 3 years to come out with the base revision. So we want to compress it as much as feasible.
Okay. So last question then has been on the issue of the MCA 21 database. I think there was a statement put out by the government yesterday. Are you completely convinced that there isn't an undue amount of sort of swing that is being created because of loopholes in the MCA 21 database?
Not really. In fact, if you look at it, we have decided to do many more surveys in this 2019-20 fiscal year, and we needed to do groundwork. The report, which has been brought up by the National Sample Survey, was a prelude to finding out what are the challenges that we're going to face in absence of a frame. Now, when they looked at the data, they found that as far as the services sector are concerned, some of the companies that were canvassed and visited, they were not manufacturing or producing, doing economic activities in the services sector. So they got excluded. But when we looked at the corporate affairs database again for those 35,000 odd companies, we found that majority of them had actually filed their returns. So as far as GDP estimation is concerned, there is no challenge because you've covered them all.
Mr. Srivastava, thank you so much for that quick conversation. Appreciate you taking the time to speak to us here on Bloomberg Quint. Some insights from the country's chief statistician, Pravin Srivastava. Okay, let's go back to the economic analysis of the data now. And I'm just going to revisit the numbers as stark as they are. 5.8% growth in the Indian economy in the fourth quarter. That is a 20-quarter low, as we said at the start of this show. And if you look at the full year growth numbers too, they've come in at 6.8%. That is far lower than where we started the year, which was 7.4% growth expectations. Though the GDP and GVA numbers this quarter, once again, I'll repeat, the big hit has come in from investment, and consumption too has continued to slacken. Let's go across to Saugata Bhattacharya, chief economist at Axis Bank, who's joining us here. Saugata, what is your sense of what these numbers, where they surprise negatively? I think you had a 6.1 kind of estimate.
Yes, 6.1% for the fourth quarter. The surprise came in almost entirely from manufacturing. So that's where, I mean, instead of a 6% growth that we had estimated, it came in at about 3.6%. So that was the proximate source of the unpleasant surprise. So be that as it may, I mean, we are still trying to figure out how to rationalize the 3.6% numbers, because the way that these numbers are formed is a combination of the IIP, the Index of Industrial Production, and the published results, the Q4 results of manufacturing companies. So the subset that we had looked at was giving us the number. Obviously, I mean, the official numbers were based on a somewhat different subset, and that we are trying to get our hands around that. But as you mentioned, the numbers are very clear that the slowdown has essentially come in from investment, particularly the capital goods companies, part of which we were also reading in the corporate numbers.
Okay. Let me welcome in Sudipto Mundle. Thank you so much, sir, for joining us. Let me get your insights into the economy, not just on a quarterly basis, but, if you look at the full year that has gone by in FY19, we have seen a fairly steep slowdown. We started the first quarter at 8% growth, and, we're ending it at 5.8%. So clearly, and I'll come to, causes, etc., but clearly this has been a tough year for the economy.
It's a very serious situation we are in now, because apart from the slowdown that we are already seeing, we have in front of us a looming agricultural drought, with nearly half the country already suffering from subnormal monsoons. There was already agrarian distress. So there's that whole crisis building up over there. And meanwhile, on all the engines, the growth drivers, exports have been tanking, and there's no outlook of that improving. If anything, it can get worse given the global situation and the potential shocks that we can be hit with. Consumption demand has been flattening out. It was bound to happen, because consumption, after all, is derived from income, and if there's only so much time that consumption can keep driving growth when the income growth is slowing down. The real autonomous factor, which was reviving, was investment, but that also now has shrunk. So really, the outlook is rather grim, I'm afraid. The only positive thing is that you now have just come in a government with a phenomenally strong mandate, and it has therefore some elbow room to take strong measures to address these very serious challenges.
Just coming back to that in a minute. Saugata, if I can just ask you for your sense of what happened on the investment side. Could there have been a little bit of sort of pre-election jitters there that would have reflected? Because one didn't hear anything that would suggest a steep fall-off in investment. I get that, for investment to pick up in a sustainable way, consumption has to remain strong. But consumption hasn't dropped off a cliff. So what is this sharp drop in investment that we've seen?
Yeah, well, I was saying that to understand that mystery, we'll have to, there were a lot of questions about whether the recovery of the investment that we were seeing for the past 3-4 quarters before this dip in this quarter was real, or it was a statistical illusion, because as you know, the official statistical picture is unfortunately heavily compromised. And there was a view that since all the other collateral indicators did not indicate that investment was really recovering, that it is possible that what we were seeing as a recovery was actually not there. But without getting into the details of this, it is difficult to take a view on this, on that.
Mr. Bhattacharya, can I come to you on that same question as to what could have happened to investment this quarter?
Sure. So as you mentioned, I mean, there were some signs of a nascent revival in some segments of some sectors, particularly electricals, engineering, etc. My own sense is that after the shock that came in from the NBFC sector in the middle of FY19 last year, around about September, August of last year, that was a shock to consumption. So consumption was actually beginning to already come down slowly. The contribution to the GDP growth that was already beginning to decline. So that was the first proximate shock to consumption. And after that, I mean, with that consumption being concentrated and being funded to a significant extent by NBFCs, I think that led to a tale of problems both for inventories built up that needed to be cleared out, etc. So a lot of capex that seemed to have been happening in the auto and auto related segment, that was the first segment that was put on hold. Then I think it was compounded by the slowdown of exports driven by external factors. So that contributed to the segments, to investment in those segments that were export driven. And finally, I think, I mean, in the build up to the elections, the pre-election uncertainty, I think that caused a lot of projects to be put on hold. So of these, I think the last two bits would be more transient, it's not very structural in nature. But the other segments, the slowdown related part and the NBFCs, that unfortunately might turn out to be much deeper. And there are other segments in the meantime, aviation, telecom, etc., which are far more structural in nature.
Okay, I'm just going to point out some numbers, and I'm looking at now the full year numbers to try and tell our viewers what has changed in the economy between FY18 and FY19. Obviously, the GDP growth number is now at 6.8%, but if you look at the expenditure side, private consumption growth in FY19, the full year is higher than last year. So it's at 8.1% compared to 7.4% consumption growth in FY18. Government expenditure is where the real change seems to have happened, because for the full year, government expenditure grew 15% in FY18 and at 9.2% in FY19. And on the capex side, actually again, FY19 full year was still better than FY18 with 10% growth compared to 9.3% growth. Mr. Mundle, what is the role that government finances have played in the way the economy has played out in FY19? Because it was very clear to us that there is pressure on government finances, yet it's very difficult to discern from the GDP numbers, because some segments like public administration are still doing strong. But if you look at the expenditure side data, that clearly shows that there has been a slowdown in government consumption expenditure.
Yeah, just one technical clarification. Sometimes the annual picture, when you're comparing FY18 with FY19, actually hides things that are already happening and which become visible in the high frequency data, namely the quarterly data. And that's something to keep an eye on. So from the quarterly data already what's happening, but there's a time lag before it shows up in the annual data. And that is why you're seeing some of what you just mentioned when you're comparing FY18 with FY19. Now that said, on the expenditure side, I have to say it was it was quite creditable that a government going into election did not engage in all kinds of fiscal profligacy. In fact, it did try to contain huge amounts of public expenditure in various areas, and that probably gets reflected, if you look at the expenditure side, in the compression of public expenditure. But having said that, it also did this by pushing it out to the non-government sector. So if you look at the public sector borrowing requirement, for instance, that is still very large, and that is putting pressure on financial markets, is preventing the interest rates from coming down, basically crowding out the space for private investment, and there are other factors that are at play over there. But as far as government spending is concerned, I think this is it. You will, as you know, that they have tried to maintain the fiscal deficit target, partly through creative accounting, but partly it's a real compression. And in any case, there's been a shortfall in tax revenues. So to maintain the deficit with the shortfall in tax revenue, they really have to compress the spending side as well.
And Mr. Mundle, if I can stay with you, doesn't one typically tend to see the first budget after a new government come in being a budget where they tighten the reins? That seems to be the expectation that they will tighten the reins in the year ahead.
Yes, absolutely. I think it is normal in a political business cycle that now, with this, especially the strong mandate, over the next 2, maybe 3 years, this government will try to do whatever it can before it again gets into the mode of the next election, and this first budget is very important. However, I think sequencing is the key, and to start taking on huge, big agenda for reforms before getting the macro fixed up, because some of it is really out of kilter right now.
I think we've lost Mr. Mundle there. We'll try and get him back. But, I'll take the opportunity to just, talk about some of the issues, big picture issues that could be plaguing the economy. Let's get those up on the screen. I think we already discussed agriculture right at the start of the show. I don't think there's anybody who can deny that agriculture and hence rural demand problems is certainly one issue. The second thing a lot of people have been pointing out is the high real interest rates. In fact, the finance secretary also said that high interest rates is a problem. Money supply growth is the other one that has been pointed out. Mr. Bhattacharya, if I can come to you on interest rates, do you believe that and looking at the actual data, do you believe that high real rates are playing a part in the slowdown that we are seeing in the economy, or lack of adequate money supply in the economy?
Well, I mean, I think it's a combination of factors. I mean, high real interest rates, high borrowing costs do play a role, particularly in an environment, in a slowing environment where cash flows come down. So the need to service interest at these higher rates definitely compresses the amount that would otherwise have been put into play into operations. So that's definitely a factor. It's the tighter money supply which actually creates the condition for the higher interest rates, because a shortage of liquidity, which is essentially what is reflected in the aggregate by the money supply, actually leads to a shortage of funds in the system, which keeps the cost of funds for various financial institutions, including banks, high, which prevent a transmission of rates into lending rates, into lower lending rates. But I think the thing is much deeper than that. For one, I think the availability of credit, not just the cost of credit, that was coming in from a segment of financial intermediaries, NBFCs, which has pretty much now completely stayed flat according to the RBI data in the second half. I think that probably is a bigger problem than the cost of credit. I think people can absorb somewhat higher EMIs, etc., for their home loans, say for instance, or their auto loans. But just the sheer lack of credit becomes a problem.
But where does that show up, Saugata? If you look at, for instance, the financing segment, it's done just fine at 9.5% growth. If you look at that chart that the RBI puts out, which is flow of commercial resources, something like that they call it, FY19 was higher than FY18. So while everybody talks about this NBFC problem, where is the evidence that has actually led to certain sectors slowing down?
No. If you see, I mean, particularly in that last monetary policy report in the April RBI, there's a very stark chart which shows that although bank financing has increased to a certain extent, taking on the shock from the non-banks, the share of non-banks in the system is absolutely flat. So actual credit would have been far higher had NBFCs also put out, if not the very high growth rates of the previous year, somewhat close to the growth rates that they had achieved. The overall flow of credit would have been far higher. And banks have taken on a bit of the credit, but particularly the small and medium enterprises and segments, which is a part of which is retail and part of which is SMEs. That's the segment that has got impacted, and particularly with all the other problems that this particular segment has faced. This shortage of credit, this credit squeeze that has particularly seems to have hit that segment. That, I believe, is the proximate cause for the current slowdown.
All right, I think we have Mr. Mundle back. Sorry, sir, we lost your line there. Just going on to the last segment, so let me sort of get your views on correctives for the economy at this point in time. I was asking Mr. Bhattacharya while we'd lost you as to whether lower interest rates or easier liquidity conditions are part of the immediate solution. To your mind, are they?
Yeah, I think addressing the NBFC problem and cleaning that up is actually quite urgent, because without that, the sluggishness of the transmission mechanism has partly to do with that. And I should mention here that apart from the large public sector borrowing requirement, there is a wedge there of the National Small Savings Scheme interest rate, which is actually quite high. And that gets in the way of a lowering of the, policy rate getting transmitted to commercial lending rates. And that is not something the RBI can deal with, or the banking sector. This is something that the government has to do. So that is one very simple thing it could do, and with strong mandate, it can probably address that. That is one thing. On the agriculture side, I think apart from other obvious things by way of giving relief to farmers and so on, I think they should begin to address seriously reform of agricultural markets, in particular the abolition of these cartels called agricultural producers marketing cooperatives, because they are the ones that prevent farmers from getting a proper value for their money, and which gets reflected in the adverse terms of trade for the agricultural sector. So these are two very immediate things that I think this new government will need to address while maintaining fiscal discipline. But some restructuring of expenditure, you cut away, there's about 5% of GDP in the form of what we call non-merit subsidies. It should seriously cut down on that while increasing spending on other urgent things like agrarian distress. And there's a huge shortfall in tax revenues, mainly because of the GST system still not being properly functional and so on. And so that needs to be addressed. The huge amounts of exemptions and concessions given, which add up to another 5% of GDP, that needs to be addressed. So actually can create quite a lot of fiscal space for spending on important things, cutting back on other things without breaching the fiscal deficit targets.
All right, Mr. Bhattacharya, last question to you. The immediate question, of course, will be, will the RBI cut next week, or the MPC actually, will they cut next week? It'll be, fairly easy to argue that they should. Beyond that, any sort of immediate expectations you have from the government to help this economy and the slowdown that we are facing?
No, so I mean, quite obviously, I mean, I think the MPC should cut at this point in time. So MPC should cut at this point in time. Global conditions are also favorable. Crude is down. U.S. Treasury yields are down. There are fears of a recession coming on. So the global side will be good. But together with rate cuts, which will take some time to play out, I think the government should spend immediately, and this would require them to think of some innovative ways in which they can get more resources in the short term.
All right, I'll leave this conversation here. Mr. Mundle, Mr. Bhattacharya, thank you so much for joining us on a quick analysis of the GDP data. Thanks for watching Bloomberg Quint. Do go on to bloombergquint.com. We've got a whole bunch of analysis on the economy up there.